Investing in private assets such as private equity, some types of real estate, and even private debt, it used to be an asset class reserved for the ultra-wealthy and, of course, institutions such as pension plans. But smaller retail investors, albeit pretty wealthy people, are now getting in. And the rewards can be great, but these investments are not without risk. Let's discuss the surge in both the supply and demand for private investments. We're joined by Mike Woollatt, Toronto-based managing director for Hamilton Lane, which is an alternative investment manager, trades in the US. Great to see you.
Oh, thanks for having me, Andy.
So Hamilton Lane, you're a global company, but the focus is private investing.
Focus exclusively in the private markets, yes. Private equity, private credit, private real estate, and private infrastructure is where we focus.
And you deal with institutions, but you have a franchise dealing with retail investors, including Canadians.
Yes, a substantial presence on the retail side. We call it Evergreen or open-ended funds here in Canada. We have an equity fund, a credit fund, and an infrastructure fund available for Canadians. And
they all, the equity fund invests in a private equity situation. Doesn't buy public companies at all?
Nope, investing exclusively in private companies. The vast majority of companies globally are private. Some 90% of them are private, and the opportunity set is really large, and we take advantage of that.
Now, you have some charts indicating that private equity has outperformed regular indices. We can look at that. One thing that was confusing me, though, this private equity return, is that just in the US or is it globally?
It's globally. Global private equity has outperformed almost all their public market equivalents, whether it's the MSCI World, S&P 500, or the like, over multiple decades now. That outperformance is due to a number of reasons. There's a very large opportunity set mismatch. 90% of companies are private, yet only 10% of the capital raised is private, and so 10% of the dollars are chasing 90% of the opportunities, so the opportunity set's there. As well, on the private side, you have the privilege of active investing. You're active versus passive. So there's things you can do to these private companies that you can't necessarily do on the public side as a passive investor. And then finally, we think on the private side, it's a better governance model for growth. The board and the management team are entirely aligned. They own all the equity in the firm. And as well, you're not quarter to quarter. You're not moving based on quarter to quarter. You're thinking longer term. And that's a huge advantage that we see on the private market side. So there's a number of reasons for that outperformance, but it's marked, yes.
One thing, though, obviously a hazard, and I think we can show some headlines that have cropped up over the past while. Some funds, most recently KingSett, the big real estate player, has had to halt distributions and redemptions. We've seen the same for Romspen, and 9 Point Partners has had to move to limit redemptions. So you can get that. You can have this liquidity problem.
Yes. I don't know the specifics of those individuals, nor would I comment on them. But in general, what you need to underwrite when you're looking at these funds is, the underlying liquidity of the liquidity process that these funds have. Remember, we are still matching a relatively illiquid asset class in private markets versus public.
Yeah.
These funds are, tend to be monthly in and outs or quarterly or annually. They're providing more liquidity than a traditional private equity fund, which is 10 to 12 years. So you need to really understand the underlying liquidity. And that goes to, you need to look at the underlying diversification, the diversification of the investor base. So are they investing as one block that could move at any one time? That's an important one. But also look at the underlying diversification in terms of the investments. What sectors are they invested in? Are they hyper-concentrated in one sector or one geography that could experience bumps that therefore they couldn't handle the liquidity? But folks do need to remember that these are relatively less liquid assets, and you need to hold these funds for a longer period of time than you might otherwise do on the public side, because this is still a long hold asset class, right?
That's interesting. There's less visibility, obviously, because I can look at what my mutual fund is holding, and I can look at the stocks every day. So to some, it's more opaque in that sense.
Yeah, the opaqueness in the private markets is some of its advantage in a way. A group like us, for instance, with this massive database we have in private markets, being able to trade on that opaqueness, if you will, the lack of information, the asymmetric information. There's no Bloomberg terminal for our stuff. And so if you possess one of those Bloomberg terminals, you can make better decisions. So the opaqueness is in some ways an advantage. I do see, and we do see, the opaqueness or the transparency coming forward more and more now as more retail investors are coming on. You're seeing more and more vehicles created. There is a lot more transparency than there was in the ecosystem. As well, the transparency publicly is not there, but with our investors, for instance, they can see a lot and see the underlying holdings and the like. It's just you're not broadcasting that widely. It's part of the material advantage we have, right?
Yeah, I do remember we used to, years ago, we had a series of segments on private investing, and actually I found it fascinating. There was all kinds of asset classes I had never heard of that are just not out there in the public market.
Yeah, if you've got private equity even has subcategory venture capital, growth equity, which is more minority investing, buyout, and you have the rise of what we call the secondaries market, for instance, which is a relatively small part of the market versus on the public side where secondaries is many times the size of the primary market. But yeah, there's a lot of sub-asset classes that are very interesting, and infrastructure, private credit are very interesting asset classes as well.
And Mike, just before we let you go, if somebody comes to you, you're talking about a minimum 50,000 investments typically.
Yeah, correct. Yeah. Most of our funds are on the retail side. Those open-ended evergreen funds, like our Global Private Assets Fund, is a $50,000 minimum. Yeah.
Mike, thanks very much.
Thanks for having me.
Mike Woollatt with Hamilton Lane, alternative investment manager that trades on the NASDAQ. And we are going to have more on private investing on BNN Bloomberg.